Welcome to another episode of our educational podcast, where we explore important financial concepts that can change your future. If you're passionate about learning how to manage your money and achieve financial freedom, you've come to the right place. Don't forget to subscribe to catch more enlightening content that empowers you to make informed financial decisions. Today, we're diving deep into the world of debt, liabilities, and the journey toward financial independence. Let's get started. To kick things off, let's define what debt and liabilities are. Debt is money that you borrow and must repay, usually with interest. It's important to understand that liabilities extend beyond just loans, they represent any financial obligation you owe. For example, if you have credit card debt or a mortgage on your home, those are liabilities. Understanding these concepts is essential because managing your debt effectively is key to achieving financial freedom. Financial freedom means having the ability to make choices without being held back by financial constraints. Think about it, wouldn't it be nice to decide where to live, how to spend your time, or what job to take without worrying about money? That's the goal. Now, while debt can be a useful tool when handled wisely, it can quickly turn into a burden if mismanaged. Let's delve into the different types of debt. Good debt versus bad debt is a crucial distinction to make. Good debt helps you build wealth or improve your earning potential. A mortgage, for instance, allows you to invest in a property that may appreciate over time. On the other hand, bad debt tends to be for items that lose value or do not provide long-term benefit. This includes high-interest credit cards used for unnecessary purchases or payday loans. The critical takeaway is understanding whether a specific debt will help you build assets or fund mere consumption. This understanding is foundational for making smarter borrowing decisions. As we explore further into debt, we can't ignore the costs associated with borrowing. When you take out a loan, you're not just paying back the money borrowed, you also pay interest and sometimes various fees. Interest is typically a percentage of the borrowed amount, while fees may include origination fees, late fees, or others. The total cost can be much higher than what you initially received. This is why understanding annual percentage rates, or APRs, is so important. It illustrates the total cost of borrowing, including interest and fees. The more knowledgeable you are about these costs, the better choices you'll make. Now that you grasp the costs tied to borrowing, let's discuss the different types of debt and their characteristics. Secured debt is backed by collateral, like your home or car. If you fail to pay, the lender can take your collateral. Unsecured debt, such as credit cards or personal loans, lacks collateral. In this case, lenders assess your creditworthiness. Revolving debt allows you to borrow and repay repeatedly, like credit cards, while installment debt, such as a mortgage or car loan, requires fixed payments over a set period. Knowing these differences helps you choose the debt type that best fits your situation. A powerful strategy for managing multiple debts comes from two popular methods: the debt snowball and the debt avalanche strategies. With the debt snowball method, you focus on paying off your smallest debts first. This can give you quick wins and motivate you to tackle larger debts. Conversely, the debt avalanche method targets the highest interest debts first, potentially saving you more money on interest in the long run. Both approaches can be effective, your choice may depend on what motivates you more. Some find the quick wins inspiring, while others prefer the mathematical savings of the avalanche method. Speaking of managing debts effectively, your credit score plays a significant role in your financial health. Your credit score indicates how likely you are to repay your debts, and it ranges from 300 to 850. A higher score often means better terms when borrowing money. Factors that influence your score include your payment history, how much of your available credit you're using, and the length of your credit history. Maintaining a solid credit score can save you thousands of dollars in interest over time. To build this crucial score, it's essential to pay your bills on time, use credit responsibly, and limit unnecessary applications for new credit. Next, let's talk about debt consolidation and balance transfers. Debt consolidation combines several debts into a single loan, which can simplify repayments and often reduce interest costs. Balance transfers, on the other hand, move high-interest credit card debts to another card that offers lower introductory rates. Both strategies can offer relief, but they also have pitfalls, such as fees or high interest rates if balances aren't paid off in time. Smart debt management means carefully weighing the pros and cons of these strategies. As we discuss debt, it's important to recognize the warning signs of falling into a debt trap. Indicators can include making only minimum payments, using credit cards for everyday expenses, or consistently borrowing to pay existing debts. To avoid this trap, it's essential to create a budget, build an emergency fund, and use credit cautiously. If you already find yourself deep in debt, don't hesitate to consult a nonprofit credit counselor who can help guide you through recovery options. Next, let's talk about living debt-free. It sounds wonderful, doesn't it? Living debt-free implies having no outstanding debts, which can contribute to significant peace of mind and financial freedom. The benefits include no interest payments, allowing more of your income to be saved or invested. However, the challenges must be addressed too. It may take longer to save for major purchases, and patience is essential. Whether you wish to live debt-free or use debt to help build wealth, it's crucial to consider the trade-offs involved. Lastly, how do we build a path toward financial freedom? It requires intention and effort. This journey includes budgeting, saving, paying down debts, and making informed decisions. It's critical to embrace financial literacy, seeking out resources that support your growth. Remember, financial freedom is not a destination but a journey filled with choices. Every positive financial decision brings you closer to living life on your own terms. Today, we explored vital financial concepts related to debt and financial freedom. We discussed the nature of debt and liabilities, distinguishing between good and bad debt, and understanding the real costs of borrowing. We also delved into various debt types, effective repayment strategies, and the significance of maintaining a strong credit score. Furthermore, we looked at debt consolidation, balance transfers, and best practices for avoiding debt traps, finishing with the benefits and challenges of living debt-free. Each of these components plays a significant role in attaining financial independence. Thank you for joining us in this informative episode. We hope you gained valuable insights into managing your debt and working toward financial freedom. Remember, every step you take toward understanding personal finance empowers you to make better choices. Don't forget to subscribe for more educational content that inspires financial literacy and equips you for a brighter future. Until next time, take care and stay financially savvy.